Hi everyone, Brad Connors with iWealth. Just wanted to introduce you guys to iWealth. We've been doing this for 25 years. There's 8 people on our team, and our job is to help people save and accumulate money and not run out of money once they retire, and to retire with purpose. We've written Fish Don't Clap, and we've got some tools and things designed around that. Today's purpose though is to talk about the markets, the state of the markets, what happened last year, and what we think could happen this year. We had the election and all that kind of stuff, and we'll get into that here in a minute. But before we do that, we have some formalities. We are with LPL Financial and registered investment advisors, and this is our disclosure page. So we get that out of the way, and then we can get into some of the other things. So questions are really important. Today we are live on Facebook, and we're also via Zoom, and we have people logged in there. There is features inside of Zoom that you can go ahead and in the chat feature and put some questions in. And the same thing with Facebook Live. Put those questions in at the end of the presentation. We'll do the best we can to address those questions and make sure that we take care of you so that you get more clarity and confidence as 2021 approaches. All right, so here are some things that we're going to be talking about today. How did stocks perform in 2020? What drove the market performance in 2020? So we got to kind of look backwards so that we can look forward. Where are we right now as we're speaking today? What's going on? Where are we? And then what did the financial professionals forecast for 2021? You know, one of the things I've learned over the last 25 years is I don't know it all. I try to study and get the best analysis that we can. And so we're going to take a look of a group of people that we trust and what their thoughts are and forecasts are for the future. Also today we have Fidelity and Putnam, which are 2 of the partners that we choose to work with at iWealth that are helping sponsor this today. And we have some information built into today's presentation from their firms as well. So how did stocks perform in 2020? Let's take a look back at last year. So if you look up here in this top right-hand corner, as of 1/3 of 2020, the S&P 500, which is 500 large company stocks, US-based stocks, okay? So when you hear S&P, a lot of times they're just talking about 500 large US stock. It's called an index. On January 3rd of 2020, it was at 3,234. The index value was at 3,234. If you go over here and look at how it actually performed, it closed the year at 3,756. So that meant that we had a 16% increase last year in the S&P 500. So if you would have had money invested on day one and looked at it, $100,000, let's say, January 1st, at the end of the year, it'd have been around $116,000 if you're invested in the S&P 500. Well, what did the average consensus think last year? So if you look down this list of where the target was for 2020, we started the year at 3,200. Morgan Stanley actually thought it was going to go down. UBS thought it was going to go down. And then we had some positives down here with Credit Suisse and Goldman Sachs. The consensus was that we would end the year at 3,272, and we actually closed at 37. So here's the deal. Nobody knows exactly. We know that markets go up and markets go down, and we're going to talk about that. Last year, the consensus was the market would go up. None of them thought it would go up as high as it did last year. In fact, if you'd have thought back to 2020 and said, listen, we're going to go through a pandemic, we're going to go through an election that takes a while to get the results, we're going to go through shutting down schools and restaurants and airplanes and people coming into our country and everything else, you would have never believed in the day that it would have been up 16% last year in the market. And here we sit, and it was up 16. So we had a fabulous year in the market, but there was some pain to get there, and we're going to talk more about that in our next slide. So what drove the market performance in 2020? What were the formulas, the catalysts that drove that 16% growth? And so we're going to look at a pretty busy slide now. And this is the S&P 500. So there's some things that are going on with this slide that are pretty busy, but take a look at these 4 things that they outline. So in the blue line, it's COVID-19. In the green line, we're talking about fiscal policy. And then we have the economy, and we've got corporate earnings. And there's some different dates, and we're going to go through this. But keep in mind this February low, and I just want you to look at this V because that's basically what had happened last year. No one could have predicted that that V would have happened and that we'd have bounced back so fast in this recession, and we did go into a recession. A lot of people think that we're out of it already, but technically we're not there yet. So we're going to talk more about these dates coming up here, but it was a really interesting year with a lot of things going on, from COVID-19 to monetary easing, fiscal policy that had changed, the economy, the PPP loans that came out, unemployment spiked from being at a 50-year low in 2019. And so let's talk some more about this. One of those key moments is the federal fund rates. And so what the Fed did is they stepped in. This is 2016, 2018, and 2020, and you saw them reduce interest rates. If you know of anybody that hasn't refinanced their debt, they need to take a look at it. They need to call their banker and look at it. We are at all-time historical lows, 2.5% roughly for a 30-year mortgage. It's cheap money, and if somebody hasn't refinanced, they need to take a look at it. The Fed knows that they need to keep this down. There's a lot of debt. We've put trillions of dollars, almost $10 trillion in stimulus over the last year on the books. And they know that they need to keep this down to keep this economy moving and things. And so we expect that to stay down. But one word of caution, don't expect 30-year mortgage rates to stay down forever. They will bounce around based upon the 10-year treasury, and we've started to see that increase here a little bit. So just a word of caution, these aren't going to stay here forever. So if you haven't did anything, if you haven't looked at your debt, you should be doing that relatively soon. So selected key policy responses. Let's just take a look at this date and what happened. So March 15th of last year, the cuts federal fund rates from a range of 0.25 to 0. So we had a Fed cut. Then on the 15th, we had quantitative easing, $700 billion in assets purchased. So the Fed came in and bought assets to shore up money markets and things like that. We had the creation of commercial paper funding on the 17th. On the 18th, we had the money market mutual fund liquidity facility to backstop those mutual funds and money markets to make sure that they were going to be there for people, so there wasn't a run on it. March 23rd, establishing the funding support credit of large businesses and liquidity for outstanding bonds. April 16th, the lending facility, the PPP. Many of our clients took the PPP loan last year, and it's really helped them. There's a lot of small business owners that wouldn't have been able to continue to make payroll without it, and it would flooded the system with some cash for these business owners to spend, as well as the stimulus money that came to spend. And we're going to talk about savings rates here in a little while, but that all helped this economy when the Congress came together, the Fed came together in March and did this big lift. The SBA and what they were able to do, and local lending facilities, what they were able to do with PPP, it really helped this economy get back up, that V-shaped recovery we had that really helped that portion of it. So S&P year-over-year growth rates, and what I want to, again, a busy slide, but I want to point out this is 2020 when you look at it right here, and take a look at those down arrows, those bar graphs that's there. You've got earnings, which is the blue line, and you can see the negative earnings that we have in the second quarter. And then they got a little bit better, and then they got a little bit better. But take a look at what their future earnings are looking at. We expect corporate earnings to continue to get better and better and better, and that bodes well for the next year in this economy. Speaking of the economy, when you take a look at Q1, 2, 3, and 4 of last year, GDP growth, so gross domestic product, everything we buy and sell in this country, what we use. Take a look what happened. Look at Q2. We were down 31%. The economy slammed shut. We stopped flying. We didn't go to restaurants. We weren't out spending our money, and we were sitting at home, and we just weren't consuming things. Take a look at what happened in Q3 though. All of a sudden we were up 33%. Q4, another 11%. So things all of a sudden righted themselves, and we got out there and we started to spend money again. Hence, some of the stocks and things that participate at stay-at-home stocks that you've heard about started to do really, really well as people started to spend money. And they had that stimulus money, PPP money, that they were spending as well. The labor market, you can take a look at what happened there. And then inflation. The big key here with inflation is the fact that we don't have a lot of inflation, and we don't expect a lot of inflation to creep in yet this year. In fact, the Fed would probably prefer to have some inflation so that they have a spot to start raising some interest rates here too. But overall, we don't think inflation's a big issue at this point. And then consumer confidence was through the roof. It went down, but then in Q3, we were back up over 100%. That means that consumers are ready to spend money. And I think that there's a lot of pent-up demand, and we're going to talk about that kind of on a go-forward basis, what that means for the economy. And then manufacturing is the last thing on this list. And when you look at manufacturing, Q2, we were down 10%, Q3 down 5%, but now we got back into the positive range in Q4. And we expect that trend in manufacturing to continue into this year, and that should bode well for the economy as well. So where are we right now? When we take a look at where things are at, these are one of my favorite charts. If you've tuned into State of the Markets in the past, you will remember these charts. Now, this is old. This is 2010. And this is what the things looked like back in 2010 when you look at all these economic indicators. And there's from global economic outlook to the political environment and those things. But notice on this chart that there's two red speedometers. And obviously green is good, yellow's caution, red is like, hey, we better pay attention to what's going on. The political environment was red, which I don't think will ever change, it doesn't seem like. But the volatility levels, the market volatility was there. But there was a lot of things, the labor market, fiscal policy, corporate profits, there was a lot of green on this chart in 2010. So now let's take a look at the exact same indicators, but now let's go 10 years later. Let's go January of 2020. So 10 years later, what do things look like? First of all, you see those two red things again, but we've got political environment and geopolitical risks. Those were the two red items when we did this presentation last year that we were looking at. But also there's more yellow. Just if you look at the slide overall, you can see there's more yellow, meaning things are getting a little bit longer in the tooth when you look at January of 2020. Now, let's take a look at where this is now. So November of 2020, now we have four red speedometers on here. We have disposable personal income turned red. The political environment is red, like I said, will always probably be there. Geopolitical risk, what's going around the world, is red, and that's been that way for a while. And then equity market valuation is negative. So stocks are getting more expensive, and we're going to talk about that and show you a chart here in a little bit. But stocks are starting to get a little bit more expensive. So it's not like we went from 2010 to 2020 and everything changed in the last year, but we are starting to see a couple more red dials and some more yellow dials that we are paying attention to as we go into this year. So leading economic indicators, let's talk about this. Busy chart, but I want to, again, to highlight the bottom down here. This is taking a look at a scale that they put all together as indicators and kind of what's going on. Back to the chart, when you look at the gray bars that are in here, those are recessions. Those are recessions going back to 1959. Take a look at this last recession that we went through, and you can see that V, and it's down here at the bottom. We're starting to see those economic indicators get better. They got so bad in the first and second quarter of 2020 that they have to get better, and they're starting to see that growth come back. So headwinds. What's going on that we are facing? What's blowing in our face from a headwind standpoint that's going to hurt us as we look at this next year? Possibly hurt us. So COVID-19 vaccine distribution. Right? When are we going to get to herd immunity? And we're going to talk about that in a little bit here too. But can we get these people vaccinated? Everybody wants it to happen. Everybody's trying their best to get it done. But can we get that thing rolled out and hammered out? Economic scarring. What are the leftover economic things that are scarring us that we're not going to be able to get over? Are we going to fly again? Are people going to get back into office buildings again and work? What does that look like after we went through this COVID scenario? Rising bond yields, we expect that to happen. It's already started to happen. That could be a headwind to the economy as costs of bonds start to go up. And then geopolitical events. overseas, China, those type of things that you're seeing in the headlines, what's going to happen overseas? And if those geopolitical events hit us, what does that do to our economy? So those are some headwinds that we're facing on a go-forward basis. Now let's talk about some tailwinds, things that would push us, things that would help us as we go into this next year. So COVID-19 vaccine, that can certainly be a positive, and it is a positive, right? If after we get people and we get to this herd immunity that we keep talking about between people that get affected and people that get the vaccine, that's a positive thing for the market. Let's open this thing back up and get people back out moving around again and traveling and those things. Continued monetary accommodation. The Fed has already said, Janet Yellen is in, they are accommodative. They're going to continue to work with this government to try to get money into people's pocketbooks so they can spend it and get out and move. So they're on the right side of the page. Corporate profits, they were written down last year. Corporate profits were, if you think about the pandemic and companies that all of a sudden, went from 100% capacity, let's say, to 50%, they've written down things. They're now starting to beat as we start to look at earnings that are being produced by these companies. And we think corporate profits is definitely a tailwind. They'll continue to get better. A healthier consumer, people that are going to get outside and start to move around again and start to spend and travel, that's going to be a tailwind. The prospect of reduced trade tensions with allies in China. It's a big one. We all know it's out there. It's been going on for years. But what does this next administration and things look like? What happens with China? What happens with trade? What happens with our other partners overseas? So we think that could be a tailwind as things start to come together and we continue with our trading partners. And then moderate inflation. It's not a bad thing to have a little bit of inflation like we talked about earlier. And I think if we have some moderate inflation, it'll be a nice tailwind for this economy going forward. So equity values, I talked about this before, a very busy chart again, but I want you to focus in on a couple things I'm going to circle. So the moving average for equity markets is this line right here, and it's 16 times earnings. So let me explain what that means. If you have a company that you own, and that company makes $100,000 this year, normally, if you were going to sell that stock, if it was on a stock exchange, it would trade 16 times your earnings. So if your earnings are $100,000, that company would be worth $1.6 million. All right, so 16 times that. When you take a look at where we're at today, it's 21 times. All I'm saying is that it's getting more expensive to buy U.S. stocks. Now, there are people on both sides of this that would argue both sides that, hey, we've got some room to grow because we just went through a recession and we went through COVID. And there'll be other people saying this thing's getting pretty expensive to buy U.S. stocks. Just keep in mind that we are above our earnings that we had, but it has backed down due to COVID. It has backed down a little bit too, but it is above our moving average. And one standard deviation is 19. So we'd like to stay between 16 and 19 right in here. And you can see where we are today is up here. So just letting you know that it seems like those stocks are a little expensive. All right, so let's move on and just talk about the vaccine a little bit and expectations that are there. Because as we said, it could be a tailwind and it could be a headwind. We're not quite certain yet. We got to see how this thing plays out. But when we look at the milestones for COVID-19, December 14th, the first Americans received the vaccine. In fact, I just saw the other day on the news that a 105-year-old woman in Minnesota got her vaccine. It's really neat to see these vaccines getting rolled out. In January of 2021, as many as 45 million Americans should be vaccinated in January of 2021. That was the estimate that we had, and I don't know exactly where that number came in. But by April of 2021, we expect 100 million Americans that want to be vaccinated will be vaccinated, which is great. So herd immunity, this slide is the first time I've seen this. This happens to be why one of our partners that we use, which is Fidelity, they put out this slide, and it's looking at when will we get to this herd immunity. And I know that I'm not a scientist and I'm not a doctor. I'm just repeating what they've put out based upon their research. And when you take a look at getting to herd immunity, you've got vaccinations, which is this blue line. You've got people that got infected, which is the purple line. But right here in July of 2021, they expect herd immunity. What that means is that we should be going backwards, that things should be going down of people getting infected with COVID, dying of COVID, those type of things. If it's July of 2021 that we reach herd immunity, we would expect this economy to be open. We would expect people's confidence to get back in their car, their planes, and travel. And we think there's a lot of pent-up demand for that. And you'll see in a minute that people have money to do it as well. So this is a really positive slide if we can get there. And I don't know any better than you, but just trying to use some research that we had from Fidelity, I really, really like this slide, and I really hope it happens that by July we get to that herd immunity that they've been talking about. All right, so let's talk about the 2021 forecast. What are we kind of looking forward to this year as far as markets and things are concerned? So gross domestic product. Remember we talked about this before. It's what we do as consumers. Everything we consume in this country, everything we do from buying gas to buying toilet paper to cleaning supplies to a new car, everything gets put into there. And so we take a look at real GDP, and then we're going to take a look at unemployment. So if we look at real GDP and we take a look at 2020 Q4, where that was before and where it is now. And you can see these numbers are lower, but you can also see that they're positive. These gross domestic product that we're moving forward, and being over 3% in gross domestic product is a good thing. And we expect that to be there for next year. Let's talk about unemployment. In 2019, we had the lowest unemployment we've had. It was down in the 3% range in 50 years. We really had no unemployment. And when we take a look at what we're thinking for next year, we think unemployment that spiked up around that 10% range is now going to be down in the 7% range. And by the end of this year, we think it's going to be at 5.8% unemployment rate. I'm going to show you a chart in a little bit that takes a look at the longevity of what unemployment is. But if we get down to 5.8% unemployment by the end of this year, we really don't have an employment issue. Everybody that's going to want to work is going to be able to be working, and that is really positive news as we look at 2021. All right, so when we talk about unemployment, we've talked about the 5.9 last year that we believe we're going to be at the end of this year. Our 50-year moving average is 6.3%. That's our moving average for unemployment. We really don't have unemployment underneath 6.3. If we get to 5.9 at the end of the year, we're at full employment, and that's a really positive sign for 2021. So we take a look at where things were. If you go back to this chart and look, you can see where we were in 2009, how this thing dropped below 3%. Then it went way up here in March, and now you can see where we're at, just under 10%, and we think that's going to continue to drop when we look at unemployment. When we look at wage growth, the wage growth average is 4%. We've had an issue with wage growth for quite some time. And when you take a look at where we had went, so watch this blue line. This is 08, and then it goes up here, and you can see where we are right now. So we had peaked, we had great wage growth that was going, and it backed off. And that's just due to shutting down the economy because of COVID, which we had to do. So wage growth is still going to be there, and we think it'll fall back in line. It just won't be as strong as healthy as we had before. And it totally makes sense, because when you think of more people being unemployed, it's easier for the employer to hire somebody, which means you don't have wage growth. When you have low unemployment, it's a lot harder to find good talent to hire, which means you got to start paying more and you have that growth. So low unemployment will push the wage growth up, if that makes sense. All right, so let's take a look at where we're at in this cycle. Take a look at this graph, and again, this is up from Fidelity, but you take a look at China, which is this bubble, and basically what this is saying is, are you in a recovery, are you in expansion, or are you in contraction? You certainly don't want to be in contraction, the bottom of that bell curve. You want to make sure that you're on that upper curve. If you think about riding a roller coaster, You want to be on that uphill trajectory. You don't want to be down in that bottom dip. So back to this chart, you look at China is leading the way, but they're also ready to kind of go over there. But then you have the Australia, you have the Eurozone, and then you got Japan, Korea, and Mexico. So US is this green dot, and it looks like we are in a recovery, which totally makes sense. It matches the information I've been sharing with you, which means that as we recover, things should still continue to get better. If earnings continue to get better, that's how the prices move on the stocks. We should see the stock market continue to improve as well. Personal savings. So think about your own situation. Think about your kids, grandkids, your friends. Stimulus money. I'm not here to get political about this, but we received stimulus money, and it looks like more stimulus money is coming, another $1,400 for some families. When that happened, we saw rates, savings rates, go up. And so when we look at this chart, you can see Q1, this is back in 18, and you can see what happened to savings rates. All of a sudden, we had personal savings soar through the roof. Why is that important with the economy? Because people have money in their savings accounts, and what do they do with that? They either invest it, which is good for us. They either spend it, which is good for the stocks, which is good for us, or they'll just leave it sit there, which typically doesn't happen. Typically, this savings rate is close to zero. And so at some point, these people will be taking this money and investing it or spending it. And that helps the economy or the markets. And that's a positive tailwind that we have pushing us as we go through this next year. So switching gears a little bit, passive versus tactical investing. I wanted to share this chart with you, and I'm gonna point out a couple of things on this chart in a second. But let's talk about what passive and tactical means, because for the normal person that doesn't invest all day long, you're like, what are you talking about? So tactical investors are money managers that will tactically move money around based upon what they see is happening and coming in the economy. Passive investors just buy and hold an index, let's say. So a lot of exchange traded funds or ETFs are passive. It's just an index going up and down. A tactical manager will buy, sell based upon what they see. And there's different periods of time where you have passive managers that outperform tactical and vice versa. And so let's look at this chart now and see where those places have been. So anything on the up arrow is active wins. So those tactical managers that are active, that's when they have won. And anything down on the bottom is when passive, just buying an exchange traded fund, has won. And take a look at this. So you go back to April of 2009 and the subprime mortgage crisis that happened there. And you look at this line, one little blip is all where you had active managers win. But then you go back to the dot-com bust, you go back to the energy crisis, savings and loan issues. When you have a gyration in the market, typically active will win. We believe at iWealth that active is going to win in the future. Again, history will show us that there's different time periods where one outperforms the other, and you certainly can do a blend as well. But we think in having an active manager on a go-forward basis coming out of this recession, coming out of COVID, is the place to be. And we have managers that do both mandates, and we can have a conversation with clients about that. But if you manage your own investments, be taking a look at an active or tactical manager versus just buy and hold in a passive. So let's take a look at real recently active and passive. This is looking at February 19th to December 12th of last year. And you can see the passive managers down here, and you can see what the active managers have did. And where have they been? So small cap and US large cap stocks, they have outperformed. Mid cap stocks, emerging market equities. So we've started to see this shift as we went through this turmoil where you started to see active outperform passive, and we think that that trend will continue on a go-forward basis. So let's look at where they think we're going this year. Remember, if I go back to the beginning of this presentation, we had our economists and companies that we follow say that we would have a gain last year, but that gain was minimal. It was about a 4% gain, and it went 16. So what do they think for this year? This year, if you look, we started the year at 3,756, which we talked about before. They think the group average is 4,117. Again, that's the S&P 500 value over this year and the growth. Bottom line is this. They believe that we're going to have a 10% increase in the S&P 500 large U.S. stocks this year. We're already on track. We're up a little bit this so far in January, but there will be some volatility, which we'll talk about in a second. But anyway, they believe a 10% increase, which is more positive than they thought last year. So that's the consensus of the group. We'll be back next year to tell you exactly how that works out, but they believe about a 10% increase. So let's talk about volatility. Volatility always happens with the markets. We know that if you're a buy and hold investor and you hold it long term, that always wins. Means we always hit an all-time high. Remember when we got to Dow 10,000 and then Dow 20,000 as a buzzword, and now we're at Dow 30,000, 31,000 as of a couple days ago. Those markets will continue to set all-time highs, but there's always lows throughout the year. Look what happened in March last year. So we were down 34% in the S&P last year, and we finished up 16%. So what this shows is that this is showing during the year the bottom, the highs and lows, and how things finish. And out of the last 39 years, 29 of them are positive. So you've got 29 out of 39 that are positive. And the average drop per year, though, is minus 13.9%. All I'm saying is be careful. Be careful that all of a sudden, if we have a pullback in the market of 10%, that your head goes to, it's different this time. It sure felt different with COVID, didn't it? And it wasn't different. We were able to weather the storm. If you were able to buy and hold, if you were able to even buy more when the market went down, you were rewarded even more. You just have to keep in mind that this market will constantly move. It always does. It averages 13% decline every single year. But 29 out of 39 years, out of the last 39, it's been positive. So keep that long-term perspective, but understanding short-term, you're going to have some volatility, and we definitely think we're going to see some of that this year as well. And if you want to have a further conversation, just call iWealth and one of the advisors can have that conversation with you. So steps for you to take on a go-forward basis. Keep us in the loop with any important life changes. Life changes, we know it happens. Retirement, job changes, kids, marriage, all those things happen. We all have those different cycles of life. I'm going it through right now with a child in college and another sophomore in high school. Things change. When those life events change, just be in touch with us. Let's see what we can do to help you. There's some planning topics that are associated with it. And I'm going to give you one that continues to stand out. When your children or grandkids reach the age of 18, you need to have a health care directive put in place so that you can call the doctor and talk about it. It happened to me. My daughter went off to school and I started thinking about what happens if it's Thursday night and she's in Minneapolis and she's in a doctor's office in a car accident. I can't talk to the doctor unless I have a legal document. So just those things happen. Know that they happen. Know that if you're in touch with us when life events happen, we can help walk you through those, get you to the right place where they can put those documents in place for you and you can sleep at night knowing you've got things covered. So get in touch with us with changes. Tell us about any concerns that you have regarding your investments. We have some great tools. We have good sound investments, but they're only as good as they can be when they're applied to your situation. Meaning, if you have money that you need in the next 3 months, it shouldn't be in the stock market. It should be conservative. We've got to make sure that we match the goals of your money to the risk. And so make sure that you're in contact with us, and if you have any issues with grabbing a statement or something comes up, call us and let's talk about it. And the last thing, make sure that your important legal and financial documents are up to date. Guys, we sit with people all day long that tell us, yep, I need to get my will done. I need to get my power of attorney done and healthcare directives done. And we make a note of it, and 6 months later they come in for the review and it's the same thing. And 6 months later they come in for a review and it's the same thing. It's like a broken record. Our job is to continue to politely nudge you, but those legal documents are so important. We're not lawyers, we won't draft them for you, but we'll help have a conversation and get you prepared to see your attorney and get that stuff set up, or accountant on the tax side of things. Tax mitigation is going to become very important as we look at the tax structure going forward, and we're here just to help you and have those conversations with you. These are steps for us to take now. What should we be doing for an action items for 2021? Keep informed through regular communication. Our commitment to you is to educate, educate, educate. We want to give you all the knowledge we have if we can and help you. We'll continue to do that, whether that be our quarterly newsletter, whether that be our weekly update. If you're not getting these things, let us know. We have a YouTube channel with over 100 videos. Facebook, we put a new video on every Friday. Connect to the iWealth page. We will continue to educate you. We have a commitment to do it, and we will continue to do that throughout this year. Manage your investments according to your personal strategy. There's no cookie cutter way to do this. Our job isn't to say you're 50 years old and you're working and have 2 kids and your investment should look like this. Our job is to sit down with you knee to knee and have a conversation about what's important to you. What do you want to have happen? And then put together the investment and whole plan around your goals. How do we help you get you there? That's a commitment that we make to you as well, and we do it day in and day out with clients. And lastly, stay on top of changes in the market environment and make prudent adjustments where necessary. As things change, like the CARES Act that came out, as RMD rates ages go from 70 to 72, as tax laws changes happen, our job is to keep informed on those things and continue to educate you and help you as we go throughout that time. And we'll make that commitment at iWealth to do that with you each and every day. But if you have any questions, the best thing to do is give us a call so that we can take care of those things for you. So we're going to go to questions now, and we're going to take a look at the questions that you put up as I've been talking here and try to address some of those. And we'll get back to you real soon on that.